OPEC chiefs and industry leaders are meeting in Vienna, which is where Dan joins us from now. Dan, good morning.
Good morning. Well, let's get straight into the conversation here in Vienna. I'm very pleased to say that Bob McNally joins us live now. He's of Rapidan Energy. Bob, so good to see you right here in Austria. Welcome to the program.
Thanks, Dan. Great to be here.
So let's dive into the conversation around oil at the moment, because in the last 24 hours, we've seen some pretty significant shifts here, not just the Saudi extension, but also this new Russia cut. Where do you think it leaves market balances and prices in the second half of the year? And what's going on with this elusive so-called tightening?
Dan, it's a remarkable time in the oil markets. I can't think of a time when you look at our balances, and it's not just ours, IEAs, EIAs, and others, and you see huge deficits. And the Saudis, the Russians, OPEC Plus are determined to put those deficits into the market. But the market is in, I'll believe it when I see it mode. We need to see those deficits materialize. If our balances are half right, crude oil prices are about to rip much higher later this year. So we just have to wait for the summer of truth. To see those tanker tracking data from Russia, to see those inventories. We're starting to see some tightening in sour barrels and spreads and term structure. You're starting to see incipient signs of it, but it's by no means a done deal for the market.
How much higher does crude oil go from here in your view?
Well, in our base case, and I would bet a pasture or two, not the whole farm on it, but in our base case, we see Brent roofing into the 90s still by the end of the year.
Okay, what's the biggest macroeconomic risk to your 90 USD price call then? Because the concern has been, what's going on with China, what's going on with higher rates globally, what's going on with this general macro malaise. Where do you see it trending?
So the risk to our view and these views is a repeat or the ghosts of 2008. In other words, what the financial markets are telling us, contrary to the data we can see, that the global oil market is about to weaken appreciably, strongly, due to tightening of credit conditions and macroeconomic concerns. If that's true, then demand growth will screech to a halt, and what we'll see is a floor in prices around this level rather than the spike we see later this year. That's the risk. It's there in the 10 to 2 year yield curve. It's there in the tightening conditions. It's there in the Federal Reserve, which is now looking like they're going to increase twice more. ECB is raising rates. UK is raising rates. So that is your risk. That's the landmine that we risk stepping on here. Similar to 2008, when you had, at some point, global oil demand suddenly collapsed by almost 3 million barrels a day.
One of the other questions I've been asking today is just how credible is this Russia cut? It's going to be on production. They also say it's going to be on exports, but where will it ultimately leave Russian production in the second half, in your view?
Well, there's a bit of ambiguity about that. Normally, we think about wellhead production. Normally, quotas in OPEC Plus are assigned to wellhead crude output. However, the message now from this OPEC Plus decision, and really Russia's decision rather, is to cut exports. And they want to do that because they want the market to see it. Those tanker trackers, they're going to see that right away. We don't have to wait till September or October to get secondary sources on output. So what OPEC Plus is expecting is that Russian supply to market exports are going to fall for all of us to see in August by 500,000 barrels a day. And if they do that, they'll be happy. And we'll just see whether production is cut or not. I think we'll have to wait to the fall to see.